Hello friends, my name is Avnish Jain and I had fixed income at Canara Robeco Mutual Fund. As we enter the last quarter of 2022, let's see if anything's changed during this year. The global war in Ukraine continues and shows no signs of ending. This looks like more a war of attrition rather than a swift war which was earlier expected, especially from Russia's side. There is another war going on, which is the war of inflation and war of central banks on inflation. Inflation in developed country is at 40 years high, and central banks have been desperately trying to tempt inflation down over the last 6 to 8 months. To this effect, the US Federal Reserve, the largest central bank in the world, has raised rates by 300 basis points in last 6 to 8 months, taking the Fed funds rates to 3 percentage points. On the other hand, oil prices continue to remain volatile. In early part of the year, because of Ukraine war, oil prices had climbed to almost $130 per barrel. In the aftermath of the war, oil prices did come down as supply from Russia, which was expected to be continued. Oil prices dropped to around $85-86 per barrel before OPEC Plus stepped in and cut production by 2 million barrels per day and taking the prices back to about $95 to $100 a barrel. Fortunately, prices did not cross $100 per barrel and now in the range of $90 to $95 per barrel. Globally, the situation remains uncertain because the rate hike cycle is still not over. The inflation in developed countries is still yet to come down, and expectations are that it will come down next year. But till then, US Federal Reserve is expected to continue to raise rates as they battle inflation worst in last 40 years. Coming to India, India has done relatively well in this crisis. We are in a better position compared to our peers and also to developed economies on all the macro parameters like growth, inflation, and external sector. Growth has been extremely good and we are seeing good traction after the pandemic lockdown ended early part of this year. Growth in first quarter was 13.5% Y on Y. Second quarter also credit growth numbers are extremely good, which is pointing to robust growth in the second quarter as well. Inflation, which has been high for some time, peaked around 7.8% in June and has been on the downtrend since then. Last month inflation was 7.4%, but from all available data, it seems that inflation would trend to 6.5% for October and then continue to go lower. As per RBI estimates, inflation should drop to 5% in first quarter of FY 2024. RBI has been very nuanced in their approach when they are looking at monetary policy. While RBI has raised rates by 190 basis points since start of this year, from April to May, and last 3 hikes have been 50 basis points each, it is not that they are following Fed, but definitely because of higher inflation in India, they are trying to break the inflation expectations in India. The latest policy details show that most of the members now are advocating that the rate hike should be more slower now and also lower. We expect that RBI may hike by 35 basis in December and probably then follow up by 25 basis in February of 2023. So taking the repo to around 6.5 percentage points. There are some sections of market which believe that RBI could take the rates to 6.25% before pausing. There are certain members in the Monetary Policy Committee of RBI who have given the opinion that 6% repo, 6.25% repo is a good level to reach before taking a pause and seeing what is the effect of the prior rate hikes on the economy, because definitely there are some slowdowns, signs of slowdown in the economy, which will come from higher rates. Rate markets reacted as expected from the initial rate hike which happened in May, which was a surprise rate hike, and since then we have seen the 10-year climb from almost 6.5 levels to 7.5, 760 levels. The short end of the curve reacted sharply because it reacts more to rate hikes, also as liquidity was withdrawn in the last 6 months. Now 10-year is around 7.5, 740 range, and it has been there for some time. We believe that 7.5 is a good resistance for the 10-year right now, and we have seen a lot of market rebound from these levels number of times. On the other hand, the short end of the curve is climbed much faster than the long end. Our 1-year CD levels are 7.5, 740, 7.5, and the yield curve is practically flat. So going forward, obviously, we expect that RBI rate hikes are mostly priced in. Markets may not react too much. There would be some volatility as expected in such markets. Oil prices are in the range of 80 to 90, 80 to 100 right now. And even after OPEC plus cut production, the prices have not crossed 100, as I noted earlier, and it is a positive sign for India. So from that angle, we don't see much pressure on rupee as well. RBI is comfortable with the rupee level. As always, they manage volatility of rupee without determining any level for rupee. So that will continue. You might see some depreciation of rupee more from these levels. So finally, the question comes, what should investors do in debt market? Clearly, we have seen a lot of volatility in last 1 year. But from what we see, the levels of rates have increased sharply. 1-year rate, which was probably around 4% at start of year, is now 7.5%. And that is exceptionally large rise in a year's time. So we believe these are good levels for investment. The yield curve is practically flat. 1-year CD is 740, 7.5, 10-year is around 740. Investors can choose any opportunity across the yield curve. Short-term investors can look to invest in low-duration funds, short-duration funds, corporate bond funds, where the maturity is low to medium. Risk-taking investors who have larger risk appetites can look to invest in long-duration funds like Income, Dynamic Bond Fund and Gilt, as well as I think investors who have 3+ year horizon definitely should look at these levels. We believe that after hiking another 40 basis to 50 basis points, RBI may pause for a prolonged period of time, and with rates where they are, it gives good opportunity for investors to lock in for longer periods of time at higher yields. Over 3-year period, it's likely that rates will be lower and investors could benefit from mark-to-market gains as well. As always, it is recommended that investors should invest according to their risk-return profile and time horizon. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.